Without objection, the chair is authorized to declare a recess of the committee at any time. Without objection, members of the full committee who are not on this task force are authorized to participate in today's hearing consistent with the committee's practice. This hearing is entitled Examining the Use of Alternative Data in Underwriting and Credit Scoring to Expand Access to Credit. I now recognize myself for 4 minutes to give an opening statement. I want to thank everyone for being here at our second FinTech Task Force meeting. Today's hearing will focus on the use of alternative data, the financial and non-financial data that is not traditionally used by national consumer reporting agencies in credit underwriting. With an estimated 26 million consumers lacking in any credit history and another 19 million with an outdated or short credit history, lenders have looked to other means of assessing the creditworthiness of applicants. As a result, alternative data has become a hot topic. It has the potential to expand credit access, but also raises concerns over the nature and sources of its data points. There is also significant regulatory uncertainty surrounding its use. Today we will hear testimony and discuss questions on all these issues. The promise of fintech lending has been to lower costs and bring new consumers into the market. This promise has been fueled by data points outside of the traditional factors used by underwriters like payment history and credit utilization. Today, lenders use an array of financial and non-financial data in their decision-making. Some factors, such as utility bill or rent payments, resemble traditional factors. Others, such as living in public housing, who your friends are and what their credit scores are, your zip code, your reading choices, educational attainment, educational institutions, and driving habits or online shopping habits are a significant departure from traditional factors. We know that Facebook has up to 52,000 data points on each of its 2.7 billion daily users, and they sell access to that data to its advertisers. Use of this and other data can potentially help 45 million Americans who might have trouble accessing credit with traditional factors alone. Take, for instance, a 28-year-old woman in a modest-paying job, or maybe with 2 very modest-paying jobs, who has never had a credit card or taken out a personal loan or mortgage loan. She might find herself denied access to credit based on traditional factors, even though she's working 12 hours a day. But a lender using alternative data might take into account that she went to a reputable school, had a job with a reputable employer, and always pays her rent and utility bills on time. In that case, they might approve her application for credit. It's very likely we have 1 or 2 staffers working here on Capitol Hill who make that exact description. However, it's not hard to imagine a similar scenario with much different results. Say a young man with a decent but short credit history might be right on the cusp of being deemed creditworthy by traditional factors. However, a lender using alternative data points sees in his rental history that he moves frequently, moves around a lot. In the last few years, he's had several domiciles. They may also see he doesn't have a college degree and that his Facebook friends have below average credit scores, so they deny him access to credit. Unfortunately, this probably describes a number of our military personnel as they repeatedly move domiciles as a result of multiple redeployments during their careers. Without question, there are instances when using alternative data in credit underwriting has potential positive impacts. However, right now, oversight of its use is either highly fragmented or completely non-existent, leading to uncertainty for lenders and potential harm for consumers. That's why we're here today, to better understand how to harness the benefits and mitigate the harms of using alternative data. I look forward to the testimony of our witnesses and the discussion of our members. With that, I will recognize the ranking member, Mr. Hill, the gentleman from Arkansas, for 5 minutes.
I thank the chairman. I appreciate you for convening this hearing and for our witnesses appearing today. We're grateful for your advice and counsel today. Analyzing the use of alternative data in the marketplace lending industry is an important sector within our broader study of the fintech ecosystem. I'm pleased that we were able to bring everybody together and do a deeper dive on this topic. Marketplace or fintech lenders are categorized through their digital or online focus and have recently emerged and grown quite a bit over the last decade. According to S&P Global, marketplace lending grew by 30% in 2017. They provide unsecured credit to individuals and working capital to small businesses. They have unique funding models with financing provided by investors, credit facilities, securitization, and of course, balance sheet cash. Typically, these lenders currently lend through two primary models: a bank partnership model in which a bank originates the loan, which is generally sourced and served by the marketplace lender, or a direct lender model in which marketplace lender acquires the applicable regulatory licensing in all the states of our country. To help determine a borrower's creditworthiness, marketplace lenders often use some form of alternative data, hence the topic today. Traditional lenders typically have used FICO scores, 3 years of tax returns, payment history for credit cards, mortgages, or student loans in order to establish a risk profile for their borrowers. However, marketplace lenders robustly combine FICO scores with alternative data points to better gauge borrower's character and economic situation. Examples of these data points include education level, employment status, utility and rent payments, etc. Utilizing these data points have the potential to widen the universe of borrowers and provide greater access to affordable credit. Importantly, a report by TransUnion outlined that lenders that utilized alternative data were able to lend to an additional 66% of borrowers in current markets and 56% in new markets. Today, we'll explore concerns about how alternative data can best comply with critical fair lending requirements, which will be discussed in more depth. However, I do want to remind my colleagues that we don't want over-regulation to stifle innovation and prevent the American consumer from now being able to access affordable credit through this new methodology. As to compliance obligations, obviously I want to highlight some of the ongoing issues that have been evolving within the marketplace lending industry. The Treasury report, which I regularly reference in these meetings, released a year ago now, provides a comprehensive review of the fintech sector. It has a robust analysis of this industry. It generally favors innovation, but identified certain important policies that need to be highlighted and discussed today, such as codify the valid when made doctrine, codify the role of the bank as the true lender of a loan that is made, allowing the testing of new credit models and data sources for financial institutions, and think through this issue of special charters or harmonization of this process across our states. The report also mentioned the third-party lender guidance. I know the FDIC and the OCC have been focused on this due to the rise of marketplace lenders and strong bank partnerships. As a former community banker, I well understand the compliance responsibilities around vendor-partner due diligence, onboarding of new partnerships, and board of director reviews. Also, as a result, as a banker, I understand the importance of banks maintaining a robust level of safety and soundness and constantly facing changing technology, but assuring vigor in compliance on both data security and privacy. I look forward to hearing the thoughts of the panel today, and over the years, I think this is going to be a fascinating way for Mr. Lynch and I to make recommendations to our full committee on how we can broaden the marketplace lending marketplace. So with that, I'd like to yield the balance of my time to my friend, our ranking member of the full committee, Mr. McHenry of North Carolina.
Thank you. And look, technology is creating new pathways for more consumers to access the financial system. That is a good thing. We're talking about people who are otherwise credit invisible or lack enough credit history to finance things like a mortgage, credit cards, or other loans. Alternative data draws on non-traditional sources of financial history, including bill payment history in areas like mobile phones that are now essential ingredients, with 81% of Americans owning a smartphone at this point or using a smartphone, and rent. And by harnessing this type of data about the consumer, lenders have a more holistic picture about the consumer to whom they are lending. Yet, this new era is not without its challenges. We need to ensure alternative data remains non-discriminatory and that consumer data and privacy are protected. So it's our job to ensure responsible innovation continues to be a driving force of the American economy, but in particular in financial services. And I yield back.
The gentleman yields. Chair now recognizes the gentleman from Georgia, Mr. Scott, for 1 minute for an opening statement.
Thank you very much, Chairman Lynch, and let me commend you for, and Mr. Hill, for providing this excellent bipartisan leadership on what I refer to as the thrilling new frontier. We are at a situation now where technology is moving at such a rapid pace, and nowhere do we need to look at where we need to adjust the sails and make sure everybody has an opportunity to be able to participate in this. And of course, as we look at this growing technology, we look at how it's impacting our financial system, there is no group that needs our help more than the 26 million Americans who have no credit history. There are 19 million Americans that have very limited. And when you put the totality of the unbanked and underbanked in there, we can see that we must not leave these parts of our population behind. So I'm looking forward to this to make sure that we determine effectively of how data is used in lending decisions and credit scoring so all the American people can participate in this glorious new frontier. Thank you, Mr. Chairman.
I thank the gentleman. He yields back. On behalf of this bipartisan task force, I want to welcome our distinguished panel. First of all, I'd like to welcome the testimony of Shishi Wu, who is legal counsel with the National Consumer Law Center based in Boston, my hometown. Aaron Ricci, Managing Director at Upturn, which is a nonprofit focused on promoting equity in digital technology through research and advocacy. Kristen Johnson, McGlinchey Stafford Professor of Law at Tulane Law School. Lawrence Evans, Managing Director of Financial Markets and Community Investment at the Government Accountability Office. And Dave Gerard, Founder and CEO at Upstart, which is a fintech lender focused on direct-to-consumer loans. Witnesses are reminded that your oral testimony will be limited to 5 minutes. Your written testimony is accepted as part of the record. Without objection, your written statement will be made part of this record. Ms. Wu, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Mr. Chair, Ranking Member Hill, and members of the task force, thank you for inviting me to testify today. I'm testifying on behalf of the low-income clients of the National Consumer Law Center. We've heard several times today that there are tens of millions of consumers who are credit invisible. The topic of this hearing, alternative data, is often promoted as the solution.
Ms. Wu?
Yes.
These microphones are rather odd, but if you
Okay.
can move it,
Got it,
directly in
right.
front of you. There you go. Thank you so much. We all want to hear what you have to say.
All right. So we've heard several times today that there are tens of millions of consumers who are credit invisible. And the topic of this hearing, alternative data, is often promoted as the solution. The thing is, alternative data includes lots of different types of data used in lots of different ways. Some types of data and uses can be helpful, others can hurt. As we say, the devil's in the details. The number one consideration for alternative data should be consumer choice. That should be the touchstone for all data collection. Now, we've heard with respect to the Equifax data breach a repeated complaint. Hey, none of us gave Equifax permission to collect our data. So let's get this right with respect to alternative data. Let's make sure it's the consumer's choice. That consumers make knowing and affirmative decisions to allow the use of this data, and the data is only used in the ways that consumers give permission for and expect. Another consideration for alternative data is whether it's used to create second chance scores for just credit invisible consumers, or whether it's dumped wholesale into traditional credit reports where it might damage the records of consumers who already have a score. We want to give credit invisible consumers a chance to be seen without hurting any of the nearly 200 million consumers who are already visible. As for types of data, bank account transaction data has shown a lot of promise, but it's also a juicy target. Debt collectors would love to get a hold of it. And bank account data can include sensitive information such as where a consumer shops. There should be appropriate guardrails for sharing bank account data. Rent payment information is another type of data that looks promising, specifically when no additional late payments are reported. But we don't want to penalize tenants who invoke their rights to withhold rent over poor conditions. Payday loan information, in contrast, is probably harmful. It's designed to lead to a cycle of debt, and just reporting it can hurt a consumer. And it's probably not necessary because since most payday borrowers actually have credit records. Gas and electric utility data can be potentially harmful if added in the wrong way. If reported monthly without giving consumers choice, it has the potential to hurt tens of millions of low-income consumers by adding new reports of 30 or 60-day late payments. In contrast, efforts to include utility data on a voluntary basis could be useful, and new voluntary products show there's no need for utility credit reporting where the consumer has no choice. And then, of course, there's big data. Things like social media profiles, web browsing history, and behavioral data. There are a lot of unanswered questions about the predictiveness and the accuracy of big data. Some of it's also troubling because it strongly reinforces inequality. For example, education, that is, what kind of degree a consumer has, is highly correlated with income and education of one's parents. And using social media profiles, particularly friend networks, also raises concerns about racial disparities, given whose most people's friends and families are likely to be. Speaking of racial disparities, we know there are tremendous racial disparities with respect to traditional credit scores. It's the result of centuries of slavery and discrimination which led to this huge racial wealth gap. Alternative financial data is also likely to have racial disparities for the same reasons. The critical question is whether the alternative data or algorithms lessen or increase racial disparities and whether it's more predictive or less than traditional models. And these two questions are closely tied to the test for disparate impact under the Equal Credit Opportunity test. If the alternative data is less predictive, there's less of a business justification for it under the disparate impact test. On the other hand, if it creates less of a racial disparity, it could be a less discriminatory alternative than traditional scoring. In terms of regulation, all third-party alternative data used for credit should be considered a consumer report under the Fair Credit Reporting Act. Unfortunately, several courts of appeals haven't respected the plain language of the FCRA and its broad coverage, and we urge Congress to reaffirm this because the FCRA has critical protections. One of the key issues with alternative data is accuracy. The FCRA addresses accuracy, and it gives consumers the right to dispute errors. The FCRA, as well as the ECOA, also requires notices for the purpose of transparency, requiring lenders to disclose the source and type of information so consumers aren't left in the dark as to the reasons for credit decisions. Having black boxes to evaluate creditworthiness should be a thing of the past. I thank you for the opportunity to testify and look forward to your questions.
Very good, thank you. Mr. Ricci, you're now recognized for 5 minutes.
Chairman Lynch, Ranking Member Hill, and distinguished members of the task force, thank you for the opportunity to testify today. We're here because approximately 45 million Americans do not have access to credit, because there's a lack of quality data with which to underwrite them. Alternative data can certainly help. I want to echo Ms. Wu and say the devil's in the details, and suggest we're really talking about two categories of data here: conventional and fringe data. Conventional data consists of things like various payment histories, bank account balances, information about an individual person's financial capacity. Fringe data consists of things like social media data, information that may be correlated with this financial capacity, but is much more further removed. Conventional data is promising, fringe data raises concerns. To understand why, think about traditional FICO credit scores. These credit scores are not conceptually complex. Most of their predictive value comes from people's payment histories. That is really the #1 factor in the recipe of FICO scores. The logic is simple. If a consumer is keeping up with their current financial obligations, it's reasonable to predict that they can take on new financial obligations. As it turns out, this same basic logic applies to many kinds of conventional data. The best available evidence suggests that bill payment histories are similarly predictive and can help otherwise unscorable consumers access credit. Another example, cash flow data obtained from a consumer's bank account with their express permission can provide an immediate high-quality picture of that person's ability to repay a loan. even without a credit bureau being involved at all. That's conventional data. The story gets murkier when we talk about fringe data. Expansive data sets about people's social connections, the kinds of websites that they visit, where they shop, and how they talk do not have the same simple, intuitive connection to each individual's ability to repay a loan. These can yield blunt stereotypes that might be predictive, but for the wrong reasons. Let me offer you an analog analogy. Imagine I offered to build you a credit scoring model that relied on a person's zip code. That should feel intuitively wrong. I want to unpack why. First, we know that geography reflects deep-seated social inequities. The result would almost certainly be textbook disparate impact. Second, judging from zip codes would paint with too broad a brush. It would do little to help many of the inscorable consumers we seek to help most who already live in low-income neighborhoods. Latching on to traditional markers of wealth and privilege aren't going to get us to where we want to be. My point is that thousands of behavioral data points thrown into a complicated machine learning artificial intelligence model can actually act and behave just like a zip code. In the absence of rigorous public scrutiny, we should be skeptical of fringe data. I want to note, because Facebook was brought up in opening remarks, that Facebook has for a number of years had a policy that prohibits third parties from using Facebook users' data for any kind of eligibility purpose. So if you see a startup company touting their use of Facebook data, ask them why they're violating Facebook's policies. That may not be the case for forever, but I think today that indicates that we're not ready to embrace this new data set. In short, this task force should focus its efforts on encouraging the use of alternative data that is closely related to loan performance, has an understandable relationship with an individual applicant's creditworthiness, and has been evaluated for compliance with anti-discrimination laws. Fortunately, this is all doable. More collection and use of alternative data make the Fair Credit Reporting Act and the Equal Credit Opportunity Act more important than ever before. I'd urge Congress to ensure that new kinds of alternative data are only used for credit underwriting, where we've researched and understood their role, and not for things like employment and insurance. Last of all, as you are all aware, thanks to the advocacy of Ms. Wu and her colleagues, any new policies around alternative data must respect important state and local consumer protections. Thank you again for the opportunity to testify, and I welcome questions.
We thank the gentleman. Ms. Johnson, you're now recognized for 5 minutes for a summary of your testimony.
Good morning, Chairman Lynch, Ranking Member Hill, members of the committee, and members of the task force. Thank you for inviting me to participate in this hearing to discuss the use of alternative data in credit underwriting and credit scoring. I'm a professor of law and associate dean of faculty research at Tulane University Law School, but I've previously worn other caps. I was an analyst at Goldman Sachs, a vice president and associate general counsel at JP Morgan, and an associate at a New York law firm with a globally recognized transactional practice. During my tenure in financial services and as an academic, I've learned a few things about financial markets, including the lesson that credit is a critical resource. Individuals and families increasingly rely on credit to finance household purchases and overcome significant unanticipated expenses. Without access to credit on fair and reasonable terms, it can be extraordinarily expensive to be poor. For families with fragile financial circumstances, credit may serve as a lifeline, enabling consumers to meet short-term debt obligations and to pay for education, transportation, housing, medicine, childcare, and even food. Two critical developments create promise for the 26 million Americans referenced earlier as credit invisibles and those without credit histories, and the 19 million Americans who have thin, impaired, or stale credit histories described as unscorable. First, the birth of big data. The collection, storage, and analysis of vast volumes of consumer data fuels artificial intelligence or automated decision-making platforms. Similar to the proliferation of AI in healthcare, employment, criminal law, surveillance, and communications, the rise of AI in finance monetizes consumer data. Consumers' web browsing, clickstream data, and social media networking, which we could describe as consumers' digital interface, is matched with or paired with consumers' financial transactions, checking and savings account cash flows, credit and debit card transactions, fueling data mining and engendering a new set of behavioral criteria we can describe as alternative data. While fintech firms integrating alternative data offer great promise, It is very much worth noting that this new species of financial market intermediaries also present great concern. In my limited time this morning, I note 3 challenges that arise when we integrate and endeavor to regulate alternative data. First, alternative data may, as mentioned earlier, disadvantage vulnerable, marginalized consumers, particularly those who are members of legally protected classes. Under the behavioral scoring models, your friends on Facebook, the people in the pictures you post on Insta, and those you chat with on WhatsApp, I'm happy to deconstruct that later for those unfamiliar, may signal more than whether or not you have street cred. These connections may determine the interest rate on your next mortgage. It is not yet clear how these new sources of data will impact credit invisibles and unscorables, groups that are disproportionately comprised of women and people of color. Unsavory lending practices, detestable marketing tactics, and usurious interest rates have too often plagued these marginalized consumers. Second, learning algorithms evaluate facially neutral alternative data, yet results unintentionally use variables that function as proxies for protected traits or result in decisions that may have a disparate impact on members of legally protected classes. Consider, for example, Amazon's recent experiment with an algorithm tasked with reviewing resumes for a software programmer position. Armed with the resumes of previous hires and general instructions regarding qualifications, the algorithm went rogue. Because previous hires were predominantly men, the algorithm began to discount references to women, including references to women's chess club captain or women's colleges. Unknowingly, the algorithm replicated historic discriminatory hiring biases. In credit decisions, these results may be actionable, as noted earlier, under the Equal Credit Opportunity Act and fair lending and fair housing regulations. Finally, alternative data raises concerns regarding consumer privacy and cybersecurity concerns. Beyond Equifax's settlement this week, there is breaking news: a 20-year-old computer programmer successfully launched a cyber attack against another nation's national revenue agency, signaling that it is imperative to ensure that any entities that collect, store, and transfer consumer data have developed sufficient security mechanisms. CRAs may also struggle with respect to the obligation to describe and explain adverse credit decisions. Because of the inscrutable nature of learning algorithms, they are non-intuitive, opaque, and their operations are not often easily explained. Finally, in my written testimony, I note as well that there are an even newer class of emerging financial intermediaries within the fintech ecosphere or ecosystem, blockchain-based CRAs. I reference in my written testimony, Bloom, one example of a blockchain-based credit reporting agency or an entity that will operate very similar to a credit reporting agency that is also presuming to rely on alternative data. For these reasons, I encourage and urge Congress to think carefully about comprehensive legislation outlining the appropriate uses for alternative data and governance, storage, transfer, and cybersecurity protections, as well as enforcement of anti-discrimination norms.
Mr. Evans, you're now recognized to give us a 5-minute summary of your testimony.
Thank you very much, Chairman Lynch. I'm pleased to appear before you, Ranking Member Hill, Ranking Member McHenry, and members of the task force to discuss the use of alternative data in underwriting. My testimony is largely based on our December 2018 report, which covered several fintech lending issues. The problem with the current credit granting ecosystem has been well articulated, namely its limits in its ability to reach certain borrowers. And we know that alternative data provides an opportunity to improve the status quo by expanding access to credit, improving prices, speeding up decision-making, preventing fraud. But it's also important to know that some of what we refer to as alternative data is not new. However, the types of alternative data available have expanded significantly due to the ability to secure large volumes of consumer and behavioral information, including data on consumers' spending and shopping habits, internet browsing history, online social media networks, educational affiliations, and other factors that may not have a clear nexus with creditworthiness. In combination with analytic techniques like machine learning, these factors provide predictive power for fintech companies looking to enhance their ability to determine who's eligible for credit. But alternative data is not a panacea. Depending on the specifics of these data and the analytical techniques used to extract information from them, these innovative approaches can bring significant risk. One of the major concerns is the usage of that data may produce lending outcomes that result in disparate impacts or violations of fair lending laws, unintentionally in some cases. For example, according to a Federal Reserve newsletter, it has been reported that some lenders consider whether a person's online social network includes people with poor credit histories, which can raise concerns about discrimination against those living in disadvantaged areas. Another concern is that there may be a lack of transparency about what alternative data are being used and how they ultimately factor into credit decisions. This potential opacity could raise issues not only for consumers, but for fintech firms themselves looking to comply with fair lending requirements. It may also be unclear whether a borrower has the ability to dispute the accuracy of the information used. The great challenge ahead is to manage the risk-reward balance of innovation and ensure our experience with alternative data does not mimic our experience with alternative mortgage products leading up to the financial crisis. To better ensure the risks are managed without stifling innovation, which is extremely important, policymakers and regulators will need to sort through a number of different trade-offs and considerations. In the meantime, implementing key recommendations that GAL has offered to regulators would assist them in addressing some important deficiencies as we see them. Fintech lenders and their banking partners we spoke to indicated they faced challenges due to regulatory uncertainty about the appropriate use of alternative data. Representatives of one bank said that a fintech's partner's use of alternative data may be attractive from an innovation and business perspective, but the bank would likely hesitate to use these data due to regulatory uncertainty. While federal agencies monitor the use of alternative data, they have not provided firms with the types of communication that they need to really think through the appropriate use of this data in the underwriting process. We believe coordinated guidance from the regulators may better position fintech lenders and their bank partners to responsibly use alternative data. In our prior work, we've also recommended that agencies formally evaluate the feasibility and benefits of adopting knowledge-building initiatives. We believe these initiatives will help firms understand the applicable regulations, improve regulators' knowledge of fintech products, and facilitate interactions between all parties. Chairman Lynch, Ranking Member Hill, Ranking Member McHenry, members of the task force, this concludes my opening statement. I look forward to any questions you might have.
Thank you, Mr. Evans. Mr. Gerard, you're now recognized for 5 minutes. Welcome.
Chairman Lynch, Ranking Member Hill, Ranking Member McHenry, members of the Task Force on Financial Technology, thank you for the opportunity to participate in today's conversation. My name is Dave Gerard, co-founder and CEO of Upstart, which is a leading leading artificial intelligence lending platform. I founded Upstart more than 7 years ago in order to improve access to affordable credit. In the last 5 years, almost $4 billion in bank-quality consumer loans have been originated on our platform using a model that combines alternative data with AI and machine learning algorithms to determine a borrower's creditworthiness. Concerns about fairness in algorithmic lending, particularly in the use of alternative data, are well-founded. As a company focused entirely on reducing the price of credit for the American consumer, fairness is an issue we care about deeply. In the early days at Upstart, we conducted a retroactive study with a large credit bureau, and we uncovered a jarring pair of statistics. Just 45% of Americans have access to bank-quality credit. Yet 83% of Americans have never actually defaulted on a loan. This is not what we would call fair lending. The FICO score was introduced in 1989 and has since become the default way that banks judge a loan applicant. But in reality, FICO is extremely limited in its ability to predict credit performance because it's narrow in scope and inherently backward-looking. At Upstart, we decided to use modern technology and data science to find more ways to prove that consumers are indeed creditworthy, to bridge that 45% versus 83% gap. We believe that consumers are more than their credit scores, and by going beyond the FICO score and including a wide variety of other information, such as a consumer's employment history and educational background, we've built a significantly more accurate credit model. While most people believe a better credit model means saying no to more applicants, the truth is just the opposite. Because Upstart's model is more accurate, we have significantly higher approval rates and lower interest rates than a traditional model. But we also understood that consumer protection laws weren't to be taken lightly. Thus, we proactively met with the appropriate regulator, the Consumer Financial Protection Bureau, before launching our lending program. After several years of good faith efforts between Upstart and the CFPB to determine the proper way to measure bias, we demonstrated that our AI-driven model doesn't result in unlawful disparate impact against protected classes of consumers. Because AI models change and improve over time, we developed automated tests with the regulator's input in order to report on the impact of our credit decisions across underserved groups on a quarterly basis. We've been providing this information to the CFPB for the last 18 months. Moreover, we were able to report to the CFPB that our AI-based system improved access to affordable credit. Specifically, our model approves 27% more consumers and lowers interest rates by 3.57 percentage points compared to a traditional lending model. For near-prime consumers in the 620 to 660 FICO range, our model approves 95% more consumers and reduces interest rates by 5.42 percentage points compared to a traditional model. And most importantly, Upstart's model provides higher approval rates and lower interest rates for every traditionally underserved demographic. That's the type of consumer benefit we should all get excited about. In September 2017, Upstart received the first ever no-action letter from CFPB, recognizing that Upstart's platform improves access to affordable credit without introducing unlawful bias. The concern that use of alternative data and algorithmic decisioning can replicate or even amplify human bias in lending is well-founded. However, in Upstart's experience, the fair lending laws enacted in the 1970s and the substance of fair lending enforcement, that is, monitoring and testing the impact on actual consumers who apply for loans, translates very well to the AI-driven world of today. But in reality, the path we walked at Upstart is insufficient to create a robust and competitive market that will maximize financial inclusion and credit access. In our early days at Upstart, we couldn't know for certain whether our model would be biased. It wasn't until loans were originated that we were able to demonstrate that our platform was fair. As an early-stage startup, this was a risk worth taking, but it's not a risk a large bank would have considered. If broader and deeper financial inclusion among American consumers is important to this committee, it's worth considering rulemaking or legislation that will provide some type of limited sandbox for model development and testing. By combining regulatory support for model innovation with rigorous and standardized testing, we can ensure that we don't forgo the clear and obvious benefits that AI and alternative data can offer to the American consumer. Thank you.
Thank you. I now yield myself 5 minutes for questioning. Thank you all. I mean, this is a great group. One of the nicer things about this task force is that it's bipartisan, and we're here for the same purpose. We're looking for guidance. We have an assortment of issues that we're confronting. Obviously, the banking industry is transformed, I think, because of technology, so that we have an old banking culture that is very much rule-based, and it seems to be merging or morphing into this sort of tech hybrid where, you know, you move fast and break things. And so there's that clash of cultures. But I can generally group our concerns into 4 areas. One is the whole issue of, you know, companies vacuuming up this personal data, this behavioral surplus, as Shoshana Zuboff describes in her book, Surveillance Capitalism. And under what conditions do consumers have a choice in terms of what gets vacuumed up and what gets used in terms of the algorithms that are employed to judge their creditworthiness or on other matters? So there's that whole permission aspect that Ms. Wu and Ms. Johnson both raised. Actually, all of you, I think, addressed that in some regard. Then the data use, how that gets used, which data is permissible to use and what is not, then one of the concerns that this committee has is regarding the security of that data. You know, we had Facebook in Mr. Marcus, who's heading up their Libra cryptocurrency project. And, you know, it's obvious from our history with Facebook. Facebook does not do privacy well. And so we worry about that. You know, if you look at the terms of service agreement, the one that's on your phone with Facebook, it's about 20 pages, and if you look at it closely, it basically, it's the opposite of a privacy agreement. It basically gives Facebook the ability to gather all your data and then sell it to their advertisers. And if you don't agree, if you don't click I agree, you don't get Facebook. So I'm worried about fintechs using that same sort of adhesion contract to get people to surrender their data in order to get the value of what Mr. Gerard has described, which is perhaps lower rates, better access to credit, all the benefits that might flow from one of the fintech lenders. And then lastly, we're struggling with how to hold people accountable with financial data. Should there be, and I asked Mr. Marcus, he wasn't forthcoming with an answer, I asked him, I said, would you accept fiduciary liability for the mishandling of consumers' personal financial data because of the consequences that can occur because of that mishandling? So, Ms. Wu, let's talk about, I mean, how do we get into this, how do we introduce this permission regime where people can, and Ms. Johnson, I'll go to you on this as well, how do we introduce this? Right now it's a permissionless, you know, vacuuming up of data. How do we change the paradigm and the model from what we have now to a more rule-based, if you will, structure with some of this, you know, some of the fintech that's emerging?
Thank you for the question, Chairman Lynch, and it is an excellent one. I mean, there's the sort of limited scope of alternative data for credit purposes, where we would urge that any legislation always be on an opt-in basis, that consumers have a choice, and that choice be real and meaningful, that it not be in the mice type of the 20 pages of fine print that you mentioned. And then on a broader perspective, privacy in general, yes, we all should have more control over our own data, the right to opt in, opt out, or even have our data deleted.
Very good. Ms. Johnson?
I think that Ms. Wu's point is absolutely consistent with what our expectations ought to be. I think the challenges are two-part. One of them technical, so I might defer to Mr. Gerard to respond as to how their model might address this very specific and technical point. But for AI to be effective, as I describe in my written testimony, there has to be a certain quantity or volume of observations available. They have to be uniform to a certain extent, and that facilitates learning algorithms' ability to work through the data in a manner that is exceptionally efficient and reduces operating costs, thereby enabling fintech lending platforms to reduce the cost of borrowing for consumers. So one of the challenges I'm very curious about how we'll navigate is the extent to which we are rightly asking that consumers consent prior to their data being used, and how we reconcile that with how machine learning algorithms operate. So I think there is a gap there that we have to have enough of a conversation about to be successful in crafting regulation. The other thing I just mentioned really quickly about consent is that to the extent that the data is being gathered really may be the point of departure for some of our concerns. So in many instances, consumers are completely unaware that the data is being gathered. And in some instances, they're voluntarily giving the data over for the better credit, opportunities or reduced price credit opportunities, which is disconcerting, to be quite honest, because it suggests those who are most vulnerable might be exposed to or exploited, in fact, by arrangements whereby they share the most intimate details of their financial lives, of their personal lives, for the purpose of getting better access to credit.
Thank you very much. And I'll yield to my friend, the gentleman from Arkansas, Mr. Hill, for 5 minutes.
Thank you, Chairman. Again, thanks to the panel. This is another really excellent panel that's been assembled for the task force work. And I think all of you bring a great perspective. Certainly, this issue of customer choice is an important one, and we all are frustrated, I think, with moving away from passwords into a more robust authentication, which is critical to a digital world, critical to fintech being successful, whether you're working at the biggest bank in the country or a great startup. We need to get beyond, password one and our name as how we are using as an authentication, and we've been talking about that a lot. Secondly, this issue of I own the data, I'm the consumer, and I'm allocating you some data for a project we're working on together, and so broadening that transparency in access to my data for a purpose of taking a decision that I want to have with an online partner. These are really important areas, and thank you for bringing those up. So, Mr. Gerard, I want to talk a little bit about your model and the alternative use, or as was described by Mr. Rickey, your expansion, I would say, of conventional data. I'll ask if you use, quote, fringe data or not, as he defined it, but we'll find out. But I'm very impressed that you've been working 18 months with the CFPB, which is a beloved institution in Washington and certainly in this committee, and therefore has eminent authority over that relationship. And congratulations for having a no action letter. We think that's a great improvement for CFP operations as a absolute serious comment, and a great way for them to demonstrate the ability for fintech innovation in a mini sandbox, if you want to call that a derivative of that. So first question is, the conventional data you expand beyond FICO. What's the nature of that in your business?
Sure. So I want to say first, the data that we use in our models comes entirely from two sources. One is a credit reporting agency, and the second is directly from the consumer themselves. So we aren't, quote unquote, hoovering data in many places. We don't take data from Facebook, et cetera. What we do is include information, and I had mentioned a couple of them. Somebody's work history. Where do they work? Are they a nurse? Are they a policeman, et cetera? Their educational history, their degree of education obtained, their area of study. These are things that are unique to our model. We also look at some behavioral things when they interact with us. What size loan do they ask for? How did they find us? Things of this nature. These all end up being helpful and predictive toward our model.
And so do you consider that, of course, it's provided by the customer, they're seeking the loan, so they've granted you permission to do that. Are you also seeing their cash flow data for a period of months by access to their bank account and making your determination?
Today, that is not something we do. We do request and with consent get access to a bank account really for verification purposes and to avoid fraud and such. Yep. But it is, as of today, not part of our credit decisioning.
You talked about that you're doing that, and of course the CFPB's learning too, and you keep some of your credit, and you have your partner bank has some of your credit originated by you on their books, and then you securitize credit. So for the loans that you keep and for the loans that are on the bank's books, of course, those are being reviewed by compliance officials for compliance with all fair lending laws and the like. Isn't that right?
Sure. There is many layers of oversight and governance over what we do. The vast majority, almost all Upstart loans are originated through bank partners, some of which are FDIC regulated, some of which are OCC regulated. So we are beholden to all of them and go through very
Right.
regular audits and such.
What is your view of what statutorily ought to change about the creation of a sandbox at our bank regulatory agencies? What does that mean to you? I see it in your testimony. You don't really explain what you mean by that. How do you define it?
Well, our belief, as I said, is the right way to handle regulation for alternative data and the use of alternative data is actually to measure the outcome, to look at its impact on consumers and whether there is bias in the outcome. The challenge with that, in the way the world works today, is you don't know until you originate the loans. So you are taking on some risk that during that period of evaluation, of building and testing that model, you could be in violation of the law, of fair lending laws. So the sandbox concept is, how do you actually make progress there? How do you actually build a better model that is both more effective, more accurate, but also fair and unbiased without testing and moving? And the notion of a sandbox is to provide some freedom, not just for a startup like we were 5 years ago, but to a large financial institution, a bank, to do the same thing.
So this is like a phase 1 or phase 2 clinical trial in the drug research industry. How long do you think that would take, and how much of a big a data set would that be in just your world of personal lending, do you think would be necessary to prove out a concept like that analytically? 18 months?
Yeah, that's a
You
great
look at it in time, or you look at it in total data set, or both?
It's a little of both, to be
Because
honest.
you've got to go through the economic cycle of these borrowers to some degree, some seasoning of these borrowers.
Well, that's really about the efficacy question, meaning does this model work well? But the fairness question actually is answered quite quickly because you know right away who you're approving, who you're not approving.
Thank you. I'll yield back, Mr. Chairman.
Chair now recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
Mr. Evans, let me start with you, because in your testimony, you provide a very good survey of the literature of the potential benefits of alternative data. But you also mentioned the risk. So, first of all, I think it would be helpful if you gave us some examples. What are we talking about when we say alternative data?
Mm-hmm.
What would that be?
So this could range from data that we've had significant experience with, like on-time rental payments, mobile payments, and the like. But it could be also data that we glean from your digital footprint online or your browser history. So it could range.
But these data points also must uphold the fair lending laws and standards that we have in place. So I think the critical question is, how do we strike the balance? How do we strike the necessary balance, particularly given the innovative nature, the rapidity of our technology moving?
Excellent. And there are two things that I'd point out from our body of work. One, we looked across the globe, and we looked at some of the innovative things other countries were doing. And they were the things like the regulatory sandboxes, and, innovation offices. So we have to understand the technology. And the way to understand the technology is to engage. And so we have recommendations that are open to regulators to make sure they're carefully thinking through whether these innovation offices and these type of knowledge sharing initiatives would be appropriate here. Also, guidance, right? So guidance is extremely important because it sets the rules of the road. It sets the parameters. And if the fintech firms aren't getting that kind of guidance, they're not.
And did you think the regulators are living up to that? Do you think they're giving this guidance properly now?
I would say no. There's certainly there are places where you can find good information from the Federal Reserve and others, but they haven't communicated this guidance in a written, formal way so that people understand that this is good guidance for people to follow. And so, when you get many touches across the fragmented regulatory system, you know, it's helpful to know that the guidance is coordinated. It's not coming from just one person.
Now, Ms. Johnson, you said in your statement a statement that I agree wholeheartedly with you. You said credit is a critical choice. It's almost a life and death choice. I mean, can you imagine not having a checking account, not having a savings account, not having a credit card, not having any history in this time? And yet, we got almost 60 million Americans in that shape. How critical, in your words, is this at this point with our unbanked? And if we fail in this ability to make the alternatives work, what would that look like? How serious is this situation facing getting and making sure these 60 million unbanked, or what you refer to as invisibles, and make them visible?
So this is a great question. Thank you. I think I might dissect or sort of bifurcate the question into two parts. One part just being thoughtful at the outset about the idea that credit, as we're describing it, originates from, or the decision-making process or determinations about credit originates from an evaluation of eligibility, right? So the notion that credit reports are used merely for credit is mistaken, right? We know that credit reports might be used in other processes to determine employment and access to other resources. So in some instances, we're talking about credit and the data that's evaluated to determine whether or not someone has access to credit as a gateway. This is sort of a gateway to a variety of critical access to a variety of critical and important resources in our society, right? So credit is a critical resource because, and credit reports are a critical factor in the lives of individuals because it may impact their ability to access other resources beyond credit, right? So that's the first point, just to segregate out the idea that what we're evaluating here, the data that's being gathered, there are many important impacts with respect to that data that are beyond just simply whether or not one qualifies for a credit card or a home mortgage loan, right? Although those access to those resources are important as well. I'd also underscore, Katie Porter was here earlier and stepped away. She's one of my colleagues, or was one of my colleagues in the Academy before joining you all here on the committee and in Congress, and her work has historically, along with others, underscored the significance of the financial status of individuals as impacting a variety of elements of their lives, and your point underscores that as well. So I just suggest that credit and the data that's being gathered for the purposes of evaluating credit will impact access to financing, but it impacts access to a number of other things, including education, right?
And Mr. Chairman, may I just ask this? One of the values of the
Gentlemen, already
fintechs.
over a minute and a half over. Go ahead, though.
Thank you. One of the values of the fintechs is that they are now providing help and services to the unbanked that our traditional banks are not doing, will not do. And I'm not going to ask you to answer that, but I'm sure you'll agree that that is an area we can develop more of to use our emerging fintechs to be a valuable asset, because many of the existing actors in the financial services industry are not going to touch these unbanked and underbanked. But anyway, thank you. And thank you, Mr. Chairman. I'm sorry.
Quite all right. The chair now recognizes the gentleman from North Carolina, Mr. McHenry, for however much time he may consume.
Well, I'll respect the chair, and thank you, Mr. Lynch. Thank you, Mr. Hill, for your leadership. It is my hope that this task force we can build some consensus around financial technology. This is a non-ideological space and otherwise highly polarized Washington. And I think it shows that we can use technology to get better societal outcomes. Well, the same or better societal outcomes that we seek in current law, We have very important provisions of law that have been put in place through a massive amount of work to ensure that we don't discriminate against people based off of what I would describe as superficial reasons, right? And that work, where you're located, what you look like, who your parents were, any of that stuff, right? And what we see now in China is that you have a social score as well, right? And it's political connections and all this stuff. And I hear this underlying the whole panel. We don't want that. Just because you're tweeting, you're a jerk on Twitter doesn't mean you're uncreditworthy. Or if you follow, nuts on the left or the right on Twitter, should not make you more or less creditworthy. So getting into the fundamentals of this, how we use alternative data. Mr. Gerard, you brought this up. Let's talk about the sandbox approach that Mr. Hill brought up in his question. The question of innovation and financial inclusion, I think, should go hand in hand. What are the benefits of a sandbox approach, Mr. Gerard, in your view?
As someone who's gone through the process we did over 4 years, frankly, with CFPB, the sandbox isn't to our advantage. We already walked the walk and walked over the coals. But honestly, in the interest of the American consumer, you want a robust environment where not just small companies, but the largest banks have an opportunity to innovate in modeling and in credit decisioning, because it can only benefit the consumer. A sandbox is necessary because, let me just give you an example. In the very early days of our lending, I met with the CEO of one of the top banks in the country, one of the largest card issuers in the country, and his words to me were, I love what you're doing, I'm really glad you're doing it, because we'll never be able to do that. And I think, honestly, it may be to my business advantage that that's the case, but it's not to the American consumer's advantage. We need innovation across the industry, not just in unsecured personal loans, but in mortgages, in auto lending, in HELOCs, in all flavors of credit.
So what would the benefit be if you use alternative data and somebody has, under a traditional score, less than A+ credit, right? But you see through alternative data that they actually pay their rent, they pay their cell phone bill, and they have never missed those payments. It enhances that credit score, right? Others, it would actually say that that credit score is not as good because they're not paying or they continue to have issues. So there's this picking and choosing when you say, well, we only want to use good stuff if it's alternative data. Well, that's not representative that everyone is a good credit risk, right? So how do you prove that out in terms of ensuring it's not discriminatory based off of our traditional metrics under federal law?
Let me just say the important background is that FICO and income, which are the two anchors of almost any lender, are terribly biased. And they are so biased that the additional of alternative data, whether that's education, whether that's the name of the company you work for, a variety of other things, actually reduce the bias in the credit decisioning because the baseline is so biased itself. So that is why it represents such an opportunity. The other really important point...
Across the panel, anybody disagree with that statement?
I would add something.
No, but any disagreement with the contents in the last 5 sentences of what Mr. Gerard said? Anyone on the panel?
There is bias certainly in the existing data, right? Because it's the result of systemic, we just talk about data collection for algorithms generally. We have to acknowledge that at the outset, the data that is being collected is biased. One of the best and easiest, most accessible examples would be in criminal law enforcement, right? To the extent that an area is over-policed by police in a particular city or area, there will be more arrests in that area.
No, but I'm talking about consumer credit, and I'm talking about the specifics of this. That is a larger societal issue. We're the Financial Services Committee and not the Judiciary Committee. So that is a major issue. I certainly understand that, and I appreciate that. But let's talk about what we're going to fix here in the Financial Services Committee. When you say that alternative data can be an enhancement, and I understand all the caveats that all of you, in a very lawyerly sort of way, if I would say, yes, it has great opportunities, but there are risks. Of course there are, right? But when we're talking about getting unbanked or credit invisible people and making them visible, that is I think that is a proper is a proper societal trade-off in order to get more people into the world of being banked rather than underbanked or unbanked. And so I appreciate the hearing, and with that, Mr. Chairman, I yield back.
Thank you, Mr. McHenry. The gentleman from New Jersey, Mr. Gottenheimer, is recognized now for 5 minutes.
Thank you, Mr. Chairman, and thank you to all of the witnesses for being here today. I appreciate it. Traditional information used to make lending decisions and establish credit scores often does not account for the 26 million customers and consumers without a credit history, or the 19 million consumers with short or outdated credit history to form a credit score, groups that are often labeled, as you know, as thin file or credit invisible. Thankfully, lenders and CRAs have started using alternative data to make lending decisions, determine credit scores, and expand consumers' access to data. I personally believe that this is the future in the era of renting and Venmo and Uber, that we need to give the next generation of consumers the ability to build a stronger credit file through non-traditional data sources. That's why I'm working on the Credit Access and Inclusion Act, legislation that would allow the reporting of certain alternative data like rent and telecom payments to consumer reporting agencies to help thin file consumers build their credit scores and hopefully access credit. We also must ensure traditional credit bureaus and those using alternative financial service data still comply with the Fair Credit Reporting Act, also known as FCRA. Ms. Wu, if I can start with you, how can we ensure that alternative data sources comply with FCRA data furnishing requirements?
Thank you for the question, Congressman Gottheimer. One of the things we need to clarify is that anytime third-party data is used for credit decisioning, it should be covered by the Fair Credit Reporting Act. The example of Facebook, for example, Facebook may have a disclaimer in its website saying you're not supposed to use it for credit, but if they're doing a wink-wink, nudge-nudge, and lenders are using it for credit, it should be covered by the Fair Credit Reporting Act. And so Congress should clarify that in the light of bad decisions. And I also want to say in the area of sandboxes, the devil is also in the detail as well. Sandboxes shouldn't be a license to ignore things like the Fair Credit Reporting Act and the requirements for accuracy, predictiveness, and notices.
Ms. Wu, could you speak a little closer into the mic?
I'm sorry, I'm having a terrible time with this microphone.
Thanks for your answer. And just to follow up to that, what kinds of alternative information would you seek to use that's not already shared by applicants or regularly requested as part of loan applications, rental payments, bank statements, and of course, under the Fair Credit Reporting Act?
So the type of data, first of all, the most important aspect is consumer choice. The consumer should be allowed the option of sharing it or not. So if they want to share their bank account data, if they want to share their utility payment or rent payment data, they should be permitted to. But if they don't want to, they want to say, hands off my data, that also should be respected. And then the lender should consider that in the same way they consider credit data. I mean, the other side of this equation of alternative data is, are the lenders actually going to use it? We've actually seen lenders who won't even upgrade the latest FICO model, let alone use an alternative score. So one of the tough parts is actually getting the lenders to look at it. And I think one of the things that this committee has done that's useful is actually passing the Chairman Lynch's bill about giving the CFPB authority to regulate the scoring models. You know, we've heard from Mr. Evans, there needs to be guidance from the regulators. Well, the best thing to do is to have the experts at the CFPB review these models and say, is this predictive, is this accurate, does this create disparate impact? And that bill that this committee passed out does that.
Do you see that changing with some of the financial institutions? Have you seen better? I know many aren't considering other data sets. Do you see that changing? Is there a desire to? How is the trend line on that? And what do you think can really spur that along?
I think that Things that will spur it along are things like, the Fannie Mae and Freddie Mac are going to be needing to update their scoring models, and we've actually encouraged the use of doing some pilots, limited pilots with alternative scores.
And are we seeing good news out of that? Are we getting more access to credit for people? Because, I think I really am grateful for your leadership in this space, because I think it's very, very important that more people have access who should get it, who qualify for it, but just because of the way we've done things forever, they're not getting access to it, or because it's so black box that you don't know what's in it. And I think that lack of transparency also has a big impact.
Fannie and Freddie have not adopted the new scoring models yet, but some of the other testing that's gone on has shown some promise. We just, again, devil's in the details. We need to be careful. There's going to be some disparate impact, but the thing about the disparate impact test is it doesn't say, okay, there's some racial disparities, you have to stop. Is there more racial disparities or less? Is it predictive? Predictiveness is so key here. And if it's not predictive, you shouldn't be using it.
Thank you so much. I yield back.
Thank you. The gentleman from Ohio, Mr. Davison, is recognized for 5 minutes.
Thank you, Mr. Chairman. I thank our witnesses, thank all my colleagues, thoughtful questions, good dialogue, and hopefully this will yield some progress in this really important space. Mr. Gerard, I want to follow up where Mr. Hill left off when he was talking with you about how much time would this take and how would a sandbox work in a regulatory framework where we maybe provided certainty for this path with legislation. And in your response to him, you said, well, we don't really need 18 months. You can know pretty quickly whether it's discriminatory or not, i.e., is it working? And I just want to pick up from there because it seems incomplete. Because, if you give credit to everyone at low rates or, say, free, it's not discriminatory. It's all free to everyone, whoever shows up, or it's a fixed rate for everyone, no matter what. It's not discriminatory. But if there's a massive default rate, it really doesn't work, right? I mean, you do care about defaults, correct? So how far into that process could we know, is it both non-discriminatory and actually effective in the sense that it provides a useful tool?
That's a good question. It certainly varies based on the nature of the product. So a mortgage, for example, plays out over many, many more years. But you do need enough data. You do need to both understand fairness and efficacy. Fairness can be sorted out fairly quickly. Efficacy takes time. You need to see how a loan performs.
Is it really fair to give money to somebody that has no hope of repaying it?
No, it's actually against everybody's best interest to do that. So ability to repay.
Right, so efficacy is inherently linked to fairness, is I guess the point. And so I'm just curious, if you look at probabilistic models and you look at the statistics and say, hey, if you've got this pattern, is there a data set that shows with a 95% certainty, 99% certainty, what range of probability of payment history in the early years? Could you say the sandbox has produced an effective tool so that it's both non-discriminatory and it's efficacious?
Well, Congressman, you're asking exactly the right questions. The sandbox has to be defined in a way that it allows the lender to decide if this new model works. And it won't be the same sandbox for every type of credit product for a variety of reasons.
Okay, so you don't, in a sense, that gives me concern because there's no real hope to pass a law that can provide certainty. It's essentially like, go negotiate your own deal with a regulator.
With all due respect, I think rulemaking could absolutely define the sandbox in terms of number of loans, how long the sandbox can operate for, the total dollars in it. There's no question in my mind that a reasonable process could define rules that put sandbox in place for the major areas of credit for consumers that would make a significant improvement in the ability to see innovation in this area.
Yeah, thanks for your expertise and appreciate your experience in the matter. Mr. Ricci, your background in privacy at the FTC is interesting because so much of this links on privacy. And in the United States, particularly in banking with Graham Bleach-Liley, financial institutions have a carve-out where they treat data differently. In a way, financial institutions, frankly, all sorts of institutions, if they were looking at their balance sheet, they might treat their data set as a valuable asset. Consumers, however, don't necessarily realize that some places, they're considered to have a property right in their data. So is it an asset for both? And as people give up this data, one of the concerns is how do we reconcile the de facto impact of GDPR and the looming patchwork of privacy laws coming in the United States and Congress's failure to act on privacy with that framework so that consumers can control their data some and not find themselves, well, wait, I was denied credit. Well, yeah, you blocked all access to your background if you go to the far end. And on the other hand, the idea that, well, gee, if you click these terms and conditions, anything that's in it's fair game. How do we regulate privacy in this space with respect to credit?
That's a great question. I think the FCRA is a strong start. If you squint at the text of the FCRA, what comes out of that is if your data is used for important eligibility purposes, certain rights and protections attach. Now, the FCRA is pretty old now, and as Ms. Wu said, if I'm like giving permission to Facebook to hand my data over to a lender, it's questionable whether or not that framework would attach. But I think looking at the spirit of the FCRA, which was created especially for these concerns, and where some expansions to that statute might make sense for the digital age would be where I'd start.
All right, thank you. My time's expired, and I yield.
Thank you. And now, the gentlewoman from Virginia, Ms. Watson, for his I'm sorry, Ms.
It's Wexton.
My apologies.
No worries.
Is recognized for 5 minutes. Ms. Wexton.
Thank you very much, and thank you to the panelists for coming today. This is really fascinating, and you're giving us all a lot to wrap our heads around. Mr. Gerard, I'm really interested in your model, and especially the fact point, the data point that it reduces interest rates by 5.42 percentage points and approves 95% more consumers in that near prime area. What kind of response are you getting from lenders about your model? Are they enthusiastic about it, or what?
By lenders, meaning banks that we partner with or aim to partner with. Thank you, Congresswoman. I would generally say there's a lot of excitement about the potential for a model like this to be able to serve more customers, to be able to build on their side, lower the risk of lending. So a more accurate model is intuitively compelling to a bank officer. Having said that, there is certainly remains a lot of concerns about regulatory uncertainty. And there is not, in any sense, a clear-eyed statement or sense from regulators how to think about this area of technology to a bank. A no-action letter that we received from CFPB is a great start. It's not by any sense a panacea because there's many other regulators. There are many limits to a no-action letter. So there's plenty of room for either regulatory action or rulemaking to provide more clarity.
Are the lenders, I understand that there's some question about regulatory certainty, but are the lenders willing to accept that your model is a more accurate credit reporting model?
I think I can confidently say
borrowers?
yes. I've almost universally seen acknowledgement that our model is more accurate and more inclusive.
Okay. And Ms. Wu had indicated that one of the things that we should consider is making any of these alternative data points that are being used for credit to be considered as a report under the FCRA. Would that impact your ability to create this algorithm, or is that something that it would not be an issue for you?
FCRA is to cover third-party data reported to and then can be shared with a lender. And that is one part of our data. The other part, which is important to us, is the data that a consumer, with their consent, submits to us. And again, that can be if they're stating their income to you. That's not something generally a credit reporting agency has information on. So there will always, at least in my mind, be two paths for data to come to a bank and a lender, one through FCRA related data through credit reporting agencies, and the other provided by the consumer themselves, and they're both important.
Okay, and thank you. And Ms. Wu, you had also indicated that there should be an opportunity for consumers to opt out of these alternative data sets being used for credit purposes. Is that correct?
Thank you for the question, Congresswoman. I actually would urge that it would be an opt-in process, that anytime you're creating these large new data sets, the consumers be, give their written authorization to have their utility or your bank account information included to be considered.
So they would have to affirmatively opt in.
Yes.
And then get it used, okay. And I guess a part of that would be a declination or a refusal to opt in could not be used against them, right? I mean, it wouldn't factor into the algorithm, but it wouldn't be down counted for not.
So if they already have a traditional credit file and score, and they decline to opt into alternative data, we would say then the lender should go ahead and use the traditional credit score. If they don't opt in, then the data can't be used, obviously.
All right. And Ms. Johnson, as a law professor, I know that you are familiar with the difference between de jure discrimination and de facto. And is there a way to be proactive in this space and make sure that that we don't end up with de facto discrimination in these algorithms, or is it always going to be retrospective, looking back and seeing what the analysis provides us?
Thank you for the question, Congresswoman. I think that there is a way for us to be thoughtful in advance of the release of these types of products in financial markets. I think earlier the Chairman Lynch referenced the move fast, break things mantra that was adopted by a number of technology firms, and now as financial technology or fintech firms are entering into spaces and operating, as Mr. Gerard mentioned, without clear regulatory guidance, there will be a temptation to use information or data, alternative data, to facilitate what may be faster, more efficient, lower cost credit evaluation processes. We do have some knowledge in advance of the types of data that tends to lead to bias or discrimination based on a long history of legislation and court decisions and agency actions in this space. So I think one of the things we can do is really identify red flags and target areas. Some of the data Ms. Wu mentioned earlier and that's been talked about over the course of this hearing that it's useful to be thoughtful about would be rental payment history, but there are any number of reasons why, and Ms. Wu's organization and others have thought about how that information may disadvantage, or utility bill payment may disadvantage certain
Ms. Johnson, the time is running out.
Thank you very much.
Thank you very much. The gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Gerard, since all banks are required to follow the ECOA and you partner with a lot of banks, what due diligence and ongoing monitoring does your company provide your bank partners to ensure that 100% certainty for those banks of no fair lending violations?
Sure. So that's a very good question. For sure, providing this technology to banks is not for the faint of heart. There is what I would say is a process of probably more than a year of them getting to understand and due diligence on our processes, fair lending being just one of many, to make sure that loans originated using this type of system are within the law, and also, of course, that the creditworthiness is real, the efficacy of the model is real. So there's real significant work before anything happens, before any relationship is signed. After the fact, there is a constant reporting and auditing-like function. The same report that we provide for CFPB for all loans, we can do for an individual bank. And that gives the bank comfort that we are actually monitoring on a regular basis to make sure the loans originated in their name, under their charter, are within the bounds of fair lending regulation.
I'd like to follow up on the previous colleagues' questions here with regards to the no action letter. You know, I'm assuming that because you have a no action letter, it's very helpful when you go approach other banks to become partner with them, because it would sort of seem like it's a get out of jail free card from the standpoint that you've already been sort of pre-approved by CFPB, that the modeling you're doing is something that falls within the guidelines of everything. How important is that no action letter whenever you start negotiating with the other entities?
It's certainly very important, and the reason we were willing to invest information and be as transparent as we were for several years with CFPB I think it is important because it demonstrates to banks that we are not a, move fast and break things company. That may be the name or sort of a label you want to paint Silicon Valley startups with, but we're not in that class. We're a company that takes regulation and working transparently with regulators serious. However, as I said earlier, it is absolutely not a panacea. They care about the FDIC, they care about the OCC, they care about state regulators, all of whom could decide to accept the CFPB's no action letter and its conclusions, or could choose not to. And that's why I think ultimately it is important to clarify regulation.
Why do you think more entities like you have not gone the no action letter route? There's not very many, if any, that have done this. Is that correct?
There's been none other to date, as far as I'm aware.
So why do you think that you're the only one that has done this? And it would seem to me to give you a marketing advantage. From the standpoint, you can, if I'm a bank and you come to me and you say, look, I've already had my modeling fall within the guidelines of the CFPB and all the other entities out here that are regulating this, and so I can, and we'll continue to put these processes in place to protect the integrity of our data. Looks to me like you've got a win-win there. Why is nobody else doing that?
Well, my only conclusion I can draw from that is one of a few things. Number one, they're not actually using alternative data in a meaningful way. Number two, they're using it, but they've found another way, another path to creating comfort that they are within the bounds of fair lending laws. Or three, they're using it, but they're not using it responsibly. And I don't necessarily know which of those is the answer.
Very good. Mr. Evans, your testimony points out that CFPB has developed fair lending examinations related to credit models, and the federal banking regulators have issued guidance to depository institutions on third-party or vendor management, including fintechs. However, despite this regulatory framework, there seems to be a disconnect between lenders and fintechs and the regulators that provide uncertainty in the fintech space. Can you explain this?
Well, yes, and I think it goes back to ultimately the fragmented nature of the regulatory system. So fintechs experience uncertainty in that regard because there are a number of actors in that particular space. CFPB's position on one thing may differ from the Federal Reserve or the OCC's position. And so I think that requires significant coordination in these kind of knowledge building initiatives that I talked about in my opening statement that will allow regulators to really understand the fintech products and ensure that the regulatory framework is adaptable and flexible.
Okay, very good. I see my time has expired. Thank you. Thank you, Mr. Chairman. All right, the chair now recognizes the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. I thank you and the ranking member for hosting this hearing. I'd also like to thank Mr. McAdams for allowing me to proceed at this time. In fact, and in truth, it would be his turn, and he's allowed me to have the opportunity to proceed. I'd like to move first, if I may, and rather expeditiously, to Mr. Gerard. Sir, the model that you currently utilize, do you maintain the traditional credit score, and then do you add these other, what you're calling alternative data points to the traditional score?
We do. We use FICO score. We use.
That's going to be enough because I have a lot to cover. I appreciate it. Thank you. I don't mean to be rude, crude, and unrefined.
Not at all.
Okay, thank you. Friends, I started with Mr. Gerard for a reason. What we're calling alternative data, in most circumstances, there may be some that I'm not covering, is really additional data. It is additional data. My bill that I have is not about alternative data. Alternative meaning one or another. It's about additional data. It's about what Mr. Gerard does when he takes the traditional data and then he adds what we are calling alternative, but it really is more data that we're adding. We're not leaving out the traditional scores. My bill does not require consumers to opt in. Consumers do this of their own volition. They can allow their additional data to be scored, and it can help a good many consumers, as evidenced by what Mr. Gerard has called to our attention. The bill is a bill that has metamorphosed I confess that initially we used the term alternative, but we soon realized that when people heard the term alternative, they assumed that we were somehow going to negate what was already there as a traditional score. So now, understanding that we are talking about additional, we're talking about the utilities, we're talking about the rent, but we simply added to what is already there. And in doing this, I think we will give many consumers the opportunity to own a home, to make purchases that they would not ordinarily. Those that don't opt in will not be, they won't have their traditional score in any way encroached upon, infringed upon. It won't have an impact on that. Only those who opt in. With that said, I want to give you an opportunity to ask me a question. Let's turn the tables, if you don't mind, so that we can become as clear as possible, perhaps perspicuously so, such that there's a better understanding of what this bill is about. I'm not going to debate persons who want to have an alternative credit scoring model. That's perfectly acceptable to me. I would only suggest that if we focus on this bill, that we use the term additional credit scoring. Question from any member of the panel, please.
I have a question, actually,
Yes,
that
thank you.
Mr. Gerard may answer. It grows directly out of your question. Thank you, Congressman, for inviting us to ask. In the first instance, we've described credit invisibles as those who do not have a traditional credit score under the FICO criteria. So to the extent that inclusion is our goal, which I think is the bipartisan motivation for the committee and our thoughtfulness today, if inclusion is the goal and the idea that you propose is that alternative data is additional data supplementing an already robust methodology for analyzing the likelihood of consumer default or predicting creditworthiness, I'm not sure I follow how credit invisibles are actually captured if the data that's being used is not the primary source of evaluation.
If I may answer, because we have 32 seconds left. You could be a great member of Congress, by the way, with your question. Here's how they're captured. Because they can opt in. And if they have nothing more, that will be there, plus the nothing, plus the something. I hate to be so elemental with the explanation, but what I want to do is make it as clear as possible that what we're doing is leaving the traditional, whatever it happens to be, and then we bring these additional points of data to the scoring process. Now, given that my time is almost up, and by some standards up, I see
Would the gentleman yield for 1 minute?
I will yield and beg that the chair would not look at the clock, if you would, please.
Okay, very quickly. I think another part of this.
The gentleman will suspend. We can't be doing this. You're over. If the gentleman wants to conclude his thought, it can, but
I can't yield?
the gentleman's time has expired. I'm sorry. Okay. The chair now recognizes the gentleman from Ohio, Mr. Gonzalez, for 5 minutes. Thank you.
Thank you, Chair and Ranking Member, for holding this hearing today, and thank you to our witnesses. I believe this hearing is an incredible opportunity to explore how new technologies can be deployed to allow more Americans to gain access to credit. That's sort of the promise, or the hope anyway, of the machine learning technology. And I share the sentiment that Ms. Johnson just raised, which is the goal is to expand credit to as many Americans as possible. Mr. Gerard, I want to focus on your company specifically in the context of the sandbox, and so we'll go there, and bear with me for a second. You were founded in 2012, according to Crunchbase anyway, have raised, I think it was $144 million in funding total. At what point did you start working with the CFPB directly in the funding stream?
I believe our first meeting with CFPB was either in 2012 or 2013.
Okay, so really from the beginning, this was a concerted effort and a decision on your part.
That's correct.
Okay. How big was the A? I don't know if you're allowed to share that, but
I'm sorry?
How big was the Series A round?
Oh,
roughly. I'll tell you where I'm going, so you can maybe answer this. So I want you to talk about the benefits of the sandbox in terms of allowing for more startups to enter the space. Because you talked about the big banks potentially being able to get into it, but I want to see more innovation. You guys have an incredible team. I was on your site, bunch of ex-Googlers and very smart folks. I know there are plenty of folks in Silicon Valley who would love to get into the space. How would the sandbox enable that?
Well, sure. The sandbox, brings some clarity, which tends to make the money flow in terms of these companies. First of all, more entrepreneurs wanting to enter this space. When you have a very highly regulated area with a lot of confusion, most entrepreneurs will opt for something else. So if you want more entrepreneurial effort in this area, bringing clarity will bring both the interest of the entrepreneurs and the money from the investors that will create companies that are going to make a difference over time.
So one of the benefits of the sandbox is not just that it gives Wells Fargo a chance, but that it gives the next group of startups a chance as well.
Without question.
Great. And then I want to shift to some of the data privacy laws that you've kind of alluded to as well. So California's privacy law is going to be coming into effect, and we hear a lot throughout the industry about the problems that that's going to create. Can you comment how you see it affecting your business specifically and AI in general?
Sure. So I believe there are real issues around related to privacy in large technology companies that need to be addressed, and I know are being addressed. And I'm very appreciative of our home state, California, taking some lead on this. And so we are, of course, already preparing, reviewing, planning to adapt our practices, our product to the California law. What I would just generally add, of course, is a business like ours operates at a national level. So it would certainly be a step forward for us to have something of that sort sort of managed at a federal level more than at a state level. But having said that, we appreciate that's not the way the world works, and we'll adapt to California's law.
Yeah, I think one of my concerns, and again that I keep hearing, is when you have this patchwork of 50 different state laws and you want to operate all over the country, as does everybody, you're creating not you, but California has created a bit of chaos, and I know one thing this committee's committed to is to solving that, which I'm excited about. And then I guess kind of with my last question, as we are thinking through what that national standard should be, what is it about what the California law that you like? What is it that you think should be changed or different? If you're not comfortable answering, that's fine. But.
Yeah, I'm not sure I'm comfortable enough to try to state that here. Thank you.
Okay, thanks. With that, I'll yield to the ranking member, or is he going to be recognizing it? Nope. Okay. With that, I yield back. Thanks.
The gentleman yields back. Chair now recognizes.
Thank you, Mr. Chair. I want to thank panelists for being here today, and I care deeply about expanding financial inclusion, but I want to make sure we're supporting an environment where all Americans can access credit. I do know that credit decisions can mean the difference between a family qualifying for a home or a loan to buy a car, and the incredible life consequences that those decisions have for each and every potential borrower. So we need to have appropriate consumer protections, and consumer protections shouldn't be ignored while we get the dial right to maximize the benefits while minimizing any potential negative impacts. But I want to zero in then on that balance, the potential benefits and the potential harm or questions that are raised from the use of alternative data. So first, speaking towards the benefits, we have heard testimony today that these alternative data factors are giving lawmakers more confidence in who they can responsibly lend to, meaning more consumers have access to credit, ideally at competitive rates. So my first question would be to you, Mr. Gerard. What percentage of your loan portfolio would you estimate that your company can make loans to because of the inclusion of alternative data sources? Or stated another way, if you were only allowed to use traditional data sources, what percentage of your customers would you not be able to lend to because you couldn't assess their creditworthiness?
Thank you, Congressman. That's a great question. That's exactly the data that I presented in my upfront statements. What the CFPB asked us to do is to look at our model if we removed all what you might call alternative data and used only traditional data. So the difference is among the general population we described as, and this is among people who have applied for loans at Upstart, is about 27%. More people are approved because of the alternative data, but importantly, when you look at near prime segment, which is people with somewhat lower FICO scores, it's 95% increase in approvals. So it's a very significant difference in improvement on who we can approve due to the alternative data that we include.
Thank you. And furthering on that point, some alternative data factors are now being used to include, or maybe not furthering the point, but in a different direction. Some of those alternative data factors are now being used to include online behavioral data, such as online shopping habits, social network connections. So my next question would be for Mr. Ricci. I believe you made this distinction in your testimony between the types of data points and the conventional alternative data. So out of curiosity, how much of these alternative data sources are moving the needle on a credit score? And I'm not referring to alternative data such as bill payments, online utility payments, of which I think most Americans would intuitively understand why that could be included in this credit score. But I guess I mean the online shopping habits, social network usage. How much does that affect an individual's data score? Are we talking 5 points of credit, 1 point, 50 points? And for someone that has a thin credit file, how much are these factors weighted compared to traditional data factors?
The short answer is we don't know. Most of the fringe alternative data that has to do with social media and shopping habits and web behavior, there's a lot more hype than reality in terms of what I've been able to ascertain in our research. There's a lot of startup companies making some pretty strong claims to the media, and then maybe once they hire a lawyer, kind of backing off those or starting to practice overseas. And so there is some academic research studies that show web signals like what website you come from, whether you're using an iPhone or an Android phone, can really help kind of narrow in on what kind of person you are, mostly because those are proxies for wealth. But in terms of the real science and research around the predictiveness of fringe alternative data, it's really hard to say because companies hold that data close, and I think there's a lot less of that really happening in the United States today because of issues with the COA.
Do consumers understand what information on them is being collected and used in their credit decisions, and are there industry standard practices on disclosure?
I'm not aware of any kind of formal industry standard best practices. There are some private businesses like Credit Karma that do, in my view, a pretty good job of showing the basic FICO score factors and helping people make sense of that. I have seen nothing resembling that for more complex or fringe data sets.
Yeah,
if I may address that, Congressman, the Fair Credit Reporting Act and Equal Credit Opportunity Act do require, if someone's turned down or priced higher for credit, that a notice go out explaining what the reasons were for. And that's really, really important because of the impact these decisions have on people's lives. And one of my concerns is that machine learning and AI, where the machine itself is determining what factors to use, how do you make sure consumers have adequate information about what's going on inside the black box? The other thing I wanted to quickly mention is another type of non-financial data that is being used, and Upstart is using, is education. And I worry about the impact of using education as a form of alternative data because we know of the great inequality and racial disparities in terms of what kind of degrees people get.
Thank you, Ms. Wu. My hope would be that we can use this data to not only expand access to credit for more individuals, but it can also be used as a form of improving financial literacy. If individuals know what data is being used and what things they might do as individuals to move the needle as well. And hopefully that doesn't include unfriending their friends on Facebook. So thank you, and I yield back.
I thank the gentleman. The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes.
Okay, thank you, Mr. Chair, and welcome to the committee. And you might have already responded on this particular issue, but it's important to me. As most of you know, credit reports do not tell the full story of one's economic status. As a matter of fact, it could have a false narrative depending on the circumstances. It is estimated that the use of alternative data such as utility payments, rent payment, cell phone payment, and other forms could expand access to credit to over 40 million consumers here in the U.S. Can everyday payments such as rent payments or cell phone payments paint a more accurate picture for someone's ability to pay. Are we headed in the right direction by saying that this would be a true picture of the individual ability to get credit? And everyone, all of you, if you care to respond to that, it'd be great. I would just like to know, and you might have already talked about it, but this is talked about all over the place, especially in Florida, where we have a high concentration of students in my district, about 80 or 90,000 up. So I'm anxious to know what your statement is going to be, and I tell you the reason being is when I was coming out of college, I was given all these credit cards, Exxon, all of them, and so I started using them. And because the invoices, I guess, were going to the dormitory where I used to live, nobody forwarded them to me. So when I got ready to try to get a loan and do some other thing, it came up. And it had been over a year or 2 years or so, and I just thought maybe because I had graduated from school, they just gave me free credit. I didn't know. And that's one of the things that affect a lot of students because they move around different places. So that's the reason why I wanted to bring that question up and have you all to respond to it.
Congressman, that is a great point. You're absolutely right. Traditional credit scores and credit reports often don't reflect the true financial behavior of a consumer, precisely because of things like your experience or the fact that there's a lot of negative marks for things like medical debt. People got sick and debts were sent to debt collectors. And we know that even among people with a subprime score, most of them, if you give them credit, will pay it back. Something like 80% of someone who scores a 600, they'll pay them back. So, alternative data could be useful, especially things like bank account or rent. And if people choose, if consumers want to supply their utility and cell phone payments, again, the devil's in the detail. How you do it is important. Second chance scores are better than putting this information in the traditional credit reports. I think we are concerned about factors that lead to more inequality or reflect inequality. So, as Mr. Wiki said, using geographic neighborhood or using what kind of degree you have, because we know that over 36% of non-Hispanic whites have a college degree, but less than 16% of Hispanics and 23% of African Americans do. So if you use whether you have a college degree or not, it's going to have some stark racial disparities.
Congressman, I want to just say I think the question of ability to repay is a really good target for this. We're talking about expanding access to credit, but we're not doing anyone any favors by giving them predatory products or too many credit products that can destroy lives. And so I think ability to repay is a really important nexus between this question of alternative data and what are we trying to find out, but also a pretty strong consumer protection standard.
And I would just echo the earlier reflections. Thank you, Congressman, for this very important question and about a really important demographic, students. So we know from the New York Federal Reserve that households face $13 trillion in debt as of the end of the year, fourth quarter 2018, and $1.5 trillion in student debt. Student debt for a particular population, the most recently graduated generations of students, is staggering and crippling. And so unlike generations past, these students are moving out of their parents' houses later, they're having extended job searches. So the predatory credit card tactics, the idea of drawing them into spaces where their credit histories will be bad, or they won't have credit histories at all because of how long it's taking them to dig themselves out of educational debt, really does prompt a need, a very significant need, for alternative mechanisms, pathways for them to gain access to credit. I think we're all just thoughtful about how to do that in a way that's effective for the consumers, protects their privacy, is thoughtful about discrimination.
Chairman, I know I'm out of time, so I yield back.
I thank the gentleman. We've agreed to just do one more brief round of questioning, and so I yield myself 5 minutes for questioning. In our discussions with Facebook, in an effort to try to get some accountability on the protection of personal financial data, the issue of assigning fiduciary responsibility for the handling of information was suggested. And I would say that the response from Facebook was evasive, to be generous. What about that concept, that there would be liability for mishandling the financial data that we surrender to fintech companies? Is that something that is workable, do you think? Ms. Wu?
I think, thank you for the question, Chairman Lynch. I think that whether you call it a fiduciary duty or you have legal duties or legal accountability for losing someone's data, there should be a regulatory scheme in place that holds big data companies, whether they be credit bureaus or Facebook, to accountability for losing sensitive personal information and data.
Yeah, I guess I should, just put a finer point on that. When I say fiduciary, I mean in the classic financial services sense, where a fiduciary is required to handle that information in the best interest of the customer, and not, sell it or deploy it for other purposes. That's what I'm getting at. I'm trying to make sure what happens with personal financial data is not what happened with general data that's being vacuumed up and used and deployed without the knowledge or consent, meaningful consent of individual consumers. That's what I'm trying to get at. Ms. Johnson?
Yes, I'd just say thank you, Congressman. We have examples and models of how to protect financial transaction data that exist in current regulation. The Graham-Leach-Bliley Act, for example, specifically requires that financial institutions disseminate initial and annual privacy notices to customers regarding financial transactions. They enable, the provision of the Graham-Leach-Bliley Act that I'm describing enables consumers to specifically opt out in certain instances of other uses of financial data. It also requires financial institutions to anonymize data, right? To essentially, to the extent they use data for other purposes, to aggregate the data and ensure that the data is anonymous and not directly reflective, or you couldn't easily discern that it refers to a particular consumer based on the profile. Now, I will say, data scientists at Princeton and Stanford recently published a study illustrating that they could successfully decode, if you will, anonymized data and establish who users were based on social networking profiles. The idea that this could happen is obviously concerning and gives us pause, but I do think that we have some examples in existing legislation and regulation that could offer a point of departure for having a conversation about how to create accountability, responsibility, and transparency for anyone who, or entities who are gathering, storing, and distributing personal consumer financial information.
Great. Let me just jump over to Mrs. Gerard. I pulled up Upstart's terms of service agreement, and it's a lot shorter than Facebook's. Thank you very much. It's about 8 pages, but there's one section in here on limitation of liability, and it says that the customer, you agree that all access and use of the site and its contents and your use of the products and services is at your own risk. In no event shall we or any lender be held liable for any damages, including direct or indirect, special, incidental, or consequential damages, losses or expenses arising in connection with the site, or any linked site, or use thereof, or inability to use by any party or in connection, or for failure of performance, error, omission, interruption, defect, delay in operation, transmission, computer viruses, etc. Very, very broad. And this is one of those things where you got to click I agree. And either you don't use either you agree to all this, or you don't use the site. You don't use Upstart. Is that fair to the consumer, do you think?
Chairman Lynch, I certainly wish we had a better option, but it's a complicated world, and certainly a business needs to protect its interests. Somebody could say, the internet crashes and I was in the middle of getting a loan, and that just cost me my ability to buy a home or do something else.
But this basically, this shuts off the consumer from any recovery. at all under any circumstances. I understand cases like that where the technology breaks down. You could say in that case we don't accept any liability, but in the terms of this is airtight, where you basically block off any type of accountability. You are beyond reach by this agreement. I just worry about, this is the type of thing I worry about. And, I'm just...
It's a fair concern. I generally believe we have the highest consumer ratings we've ever found in our industry in terms of our respect and the way we treat customers or prospective customers.
I appreciate that. I'm just concerned that, no one has any recourse based on the terms of this agreement. Let's see. With that, I yield to my friend, the gentleman from Arkansas.
Thank you, Chairman. Just following up on that, Mr. Gerard, that particular thing he read, which obviously we haven't read, but I admire him in real time going to your website. It's a thing of beauty. And it's the difference between the House and the Senate, Mrs. Johnson. You seem rather concerned about our technological capabilities here. That's really talking about the connectivity between the customer and you, isn't it? Protecting you from liability from the internet or from the website or the connection. Isn't that what that's mostly addressing?
Certainly, any commercial agreement between a consumer and a business has to have reasonable protections in it. I'm not an attorney, let me just admit, so for me to say what is an appropriate limitation of liability is not something I'm probably equipped to speak about today.
But we appreciate that, and that's something that we all deal with in any kind of commercial transaction. I think it's made worse sometimes over the internet because you don't have any kind of face-to-face explanation, and it's a little bit more passive. But I think making sure consumers know what they're getting into is important. Mr. Evans, I wanted to ask you, I read your testimony, thanks for it, about this harmonization between the regulatory agencies. You've urged them adopt a harmonized approach to guidance under use of alternative data and also on the sandbox issue. Did they give you a time frame when they would have a harmonized view on that?
They did not. They all agreed with the recommendation and appreciated the spirit of it.
Right. So I think that's something we've all talked about here, and so we'll be certainly pressing them for this more unified approach on vendor due diligence in an IT exam. Guidance on what's an appropriate bank risk profile in this arena, how to do the board review of vendor due diligence. All this is important. Mr. Evans, did you, in your work in this, see any reason to make statutory changes to the Fair Credit Reporting Act or the Equal Opportunity Credit Act?
There are certainly some issues. The scope of the work didn't allow us to rigorously collect all the evidence for us to provide a conclusion on that. But for sure, the complexity of some of the algorithms could limit the type of information that a company is able to provide if they were to deny credit to an individual.
Yeah, I read that reliability of data point in your testimony, and we've talked about that with other witnesses at previous panels, with just asking the simple question, using an AI-based model, a machine learning model that uses additional data, just as Mr. Gerard has described, we've asked the question, is it auditable? And in the instances that we've had, the answer has been consistently yes. And the evidence of that is not hypothetical because the loans originated are subject to a fair lending exam by a commercial bank or portfolio buyer. And then, of course, in Mr. Gerard's case, are also auditable by the CFPB's analysis of this data. So as long as a commercial bank is a partner in it, from my point of view, that seems like the desperate impact test, the HMDA test, if it would be a mortgage or fair lending or equal opportunity type assessments would be made. Is that generally your view from the work you did, that while you may have found 6 industry stakeholders who you had concerns about, it is doable to validate a model and have an audit trail as to how the determination was made, isn't it?
In the models that we considered, I would say yes, but I would say our work was limited to the fintech companies we actually talked to. There could be classes of models that make it
but
more
I mean, but the obligations on that user, that innovator, whether it's a bank partner or a fintech non-bank partner, to demonstrate that they comply with all the compliance obligations of the federal government. Mr. Gerard, yours, you've said already, it's auditable, and the CFPB audits it, and then your bank partner audits. That's correct, right? You can validate your model and backtrack it.
That's correct.
And one question that didn't come up today, I didn't hear it, is back testing. We've had the most ideal circumstances of the past 11 years, thanks to the unbelievable policies of our Federal Reserve, so that we have a very benign interest rate environment. We have rising real wages. We have a rising economy. What about back testing your $4 billion you've originated, looking back under more adverse credit circumstances? What have you learned?
Sure, that is a valid concern, and certainly any lender to earn its stripes really needs to perform through an economic cycle. We test the best we can by simulating higher unemployment. So there's ways we can simulate higher unemployment and look at the impact we expect it to have on our loan portfolio. Secondly, because there actually are recessions, what I might call micro recessions in parts of the country, small parts of the country, we can actually look at loan performance in those particular areas. It's not a perfect proxy, but it's a way to understand how our loans would perform in a weaker economy.
I thank the panel, and I yield back, Mr. Chairman.
Gentleman yields back. The chair now recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
Yes, Mr. Lynch, this has indeed been a very, very informative hearing. And our panelists are well prepared and very informative. Thank you for this. As I said in my opening statement, we're at a new frontier here, and it's an exciting frontier. But let's go back to the alternative data, because I think that is really the fundamental foundation of this hearing. Now, there are different kinds of alternative data that I'm hearing. So you may say a utility bill, or you may say your online habits, or you may say your educational attainment. So tell me, how does a lender weigh these? Would they give more preference to your educational attainment? Does that have the same weight as your utility bill? I mean, how is it used by lenders when they're making these underwriting decisions? Let me start with you, Ms. Wu. Or is there anybody that has an immediate answer to this? Or if we don't have an answer to it, don't you think we should?
I'm glad to answer, Congressman, as one who does exactly what you are asking about. Traditional lending systems are what you might describe as rules-based, okay? A series of, if the person's FICO is between this and that, if their income is between this and that, here's what we can offer them. Okay, that's what you might call a rules-based system. These newer models, what are sometimes termed machine learning or AI, are far more sophisticated than that. What they really do is they look at the history of loans and the data that's come in about those loans, and it learns about how each of those factors actually impacted the performance of the loans. So it's not a human sitting there trying to evaluate whether, education or FICO or something else is more predictive. The software will learn over time what's the best combination of that information that will be the most accurate model. So the goal of a company like Upstart is to build a more accurate model, which tends to lead to higher approval rates. And we do that by relying on the software to do things that humans can't realistically do, which is to consider not 2 or 3 variables, but hundreds or maybe even 1,000 variables. And that results in a more accurate credit model. And Fortunately, it also results in one that approves more people at lower rates.
So you're saying that the machine has a more accurate ability to give a certain alternative data more weight over the other. I mean, it just seems to me that, I guess what I'm saying is that, is there more benefit for one type of alternative data to be helpful to the unbanked or underbanked? I mean, there's a variety of things. Maybe also added in there, did he serve in the service? What was his rank? Was he a school teacher? Maybe got law off. What was the caliber of his employment structure? You see what I'm saying? There seems to me, if we just put all this up to the machine, I'm not sure it's giving it. There ought to be some weight here.
So that is a great point, Congressman Scott, and something I'm concerned about because, on one hand, data that kind of looks like credit, as Mr. Rinke said, rent or bank account or utility bills, everybody can, if they have a good history, can benefit from that. But if you're talking about things like education, I mean, how many college grads really are credit invisible? I mean, are we really expanding access to credit if we say, we'll give you a higher score if you graduate from college, especially if you graduate from an elite institution?
Right.
And then in terms of machine learning, the one thing I want to add is, yeah, it may be up to the lender to give what weight, but the lender's got to be able to explain it. And if all this data is going into a big black box and the machine is deciding what's more important or not, you got to be able to put it on a piece of paper and explain to the consumer what was more important. And now the law requires that because we need transparency in lending.
Yeah. Thank you, Mr. Chairman. Great panel.
And so there's I'm sorry.
If you can be quick, Mr. Evans.
There's an important trade-off to think about, transparency versus predictability. And that's something we have to grapple with, and it's something where the regulators can offer guidance.
Thank you very much. Appreciate that. The chair now recognizes the gentleman from Florida, Mr. Lawson, for 5 minutes.
Okay, thank you. And
Mr. Chairman, could I need to just, I think, politely object. I thought we were going to do just ourselves for a final round of questioning, and I have no more members here, and so with all due respect to my friends, that's not really what we agreed to, so.
Okay, I understand that the gentleman is short on time, and I totally respect him, but when I asked for a second round, I meant a second round for the members.
But you said a second round for the two of us, sir.
Sir, I was not aware that that's the way you understood that.
That is the way you said it, and that's the way I understood it.
Well, yeah. Perhaps I meant the two of us, meaning the two sides. I know the gentleman had no other.
We have no more other members, so I think in just fairness under the rules, if with the deference of Mr. Scott being the last questioner, that would be appreciated.
The gentleman, Mr. Green, has yielded, and gentleman, Mr. Lawson agrees as well? Okay. Without objection, the chair moves to include in the record of this hearing a letter from the Cato Institute Center for Monetary and Financial Alternatives dated July 24, 2019, and a letter from the Financial Data and Technology Association dated July 23, 2019, and also an article from the Student Borrower Protection Center entitled Educational Redlining, the Use of Educational Data in Underwriting. All of those I submit to the record. I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I will ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And with my apologies to the ranking member, this hearing is now adjourned.